Every year, Americans hand over $2 trillion to insurance companies. Most people have absolutely no idea what happens to that money next. By the end of this video, you will understand exactly how insurance works and how to use that knowledge to protect your family's financial future forever. The idea of protecting against loss is almost as old as civilization itself. In 3000 BCE, Chinese merchants would scatter their cargo across several vessels, not for convenience, but for survival. If one ship sank, they would only lose a fraction of their wealth. That was the seed of what we now call risk pooling. Babylonian traders took it further with something called bottomry loans. If your ship was lost at sea, the loan was forgiven. It was primitive insurance, baked into ancient commerce. But modern insurance as we know it was born in a London coffee house in 1688. A man named Edward Lloyd ran a gathering place where sailors, merchants, and investors came to trade information about ships and voyages. Those willing to accept financial risk in exchange for a fee would write their names under a description of the voyage, and so the term underwriter was born. That coffee house became Lloyd's of London, still the world's most famous insurance market over 3 centuries later. The genius of insurance is almost mathematical in its elegance. Instead of one person bearing the full catastrophic cost of a disaster, thousands of people each contribute a small amount so that nobody faces financial ruin alone. Here is what most people fundamentally misunderstand about insurance. When you pay your monthly premium, you are not putting money aside for your own future use. You are joining a risk pool with thousands, sometimes millions, of other people. Insurance companies employ highly specialized mathematicians called actuaries. Their entire job is to calculate with remarkable precision exactly how many people in any given pool will experience a loss this year. Using mortality tables, claims history, geographic data, and hundreds of other variables, they set premiums that, across the entire pool, will always exceed expected payouts. Life insurance companies know statistically that out of every 1,000 35-year-olds, a specific number will die this year. They price accordingly. The difference between what they collect and what they pay out after operating costs becomes profit. But here is the part that will change how you think about insurance forever. Most insurance companies do not make their primary profit from underwriting. They make it by investing your premiums. From the moment you pay your premium until the moment a claim is paid, which could be years, the insurance company is investing that float in stocks, bonds, treasury securities, and real estate. Warren Buffett built Berkshire Hathaway into the most successful investment holding company in history, largely because insurance subsidiaries gave him access to enormous amounts of free-floating capital. When you understand this, everything about how you buy insurance changes. There are 3 main types of life insurance, and choosing the wrong one could cost your family hundreds of thousands of dollars. Term life insurance is the simplest and most powerful option for most people. You pay premiums for a fixed period, typically 10, 20, or 30 years. If you die during that window, your beneficiaries receive the death benefit tax-free. If the term expires and you are still living, the policy simply ends, just the peace of mind you had. Term is the most affordable form of life insurance by far. A healthy 35-year-old non-smoker can purchase a $1 million 20-year term policy for around $40 per month. Whole life insurance is permanent coverage that lasts your entire life and builds a cash value over time. Sounds appealing. The reality is that premiums run 5 to 15 times higher than comparable term coverage. The cash value grows at 1 to 2% annually after fees, well below even modest market returns. Universal life insurance sits between the two. Flexible premiums, adjustable death benefits, a cash value component. The complexity hides significant risk. Millions of policyholders have discovered their policies lapsing decades later because low interest rates eroded cash value projections. The near universal recommendation from independent financial experts: buy term and invest the difference. Take what you would have paid in whole life premiums, buy term instead, and invest the remaining amount in low-cost index funds. Over 20 to 30 years, the math is almost always dramatically better. American health insurance is widely described as complicated, but once you understand 5 key terms, the entire system makes sense. First, the premium. This is what you pay every single month, whether you visit a doctor or not. Second, the deductible. This is what you pay out of pocket before your insurance begins covering costs. Third, co-payments, fixed fees for specific services. Fourth, the out-of-pocket maximum. This is the ceiling on what you will pay in any given year. Once you hit it, your insurance covers 100% of covered services. Fifth, the network, the specific doctors, hospitals, and facilities your plan covers. Going outside the network can triple your costs overnight. Here is the strategy most people overlook. If you are young and relatively healthy, choose a high-deductible health plan and pair it with a health savings account. Your premiums will be significantly lower. Every dollar you contribute to the HSA is tax-deductible going in. It grows completely tax-free inside the account, and you can withdraw it tax-free for qualified medical expenses. That is a triple tax advantage that millions of Americans are simply leaving on the table. Auto insurance is where most people overpay, not because they are being tricked, but because they do not understand what they are actually buying. Liability coverage pays if you cause an accident and injure someone or damage their property. It does not cover damage to your own vehicle. Collision coverage pays to repair or replace your vehicle after an accident, regardless of who caused it. Comprehensive coverage handles everything else: theft, vandalism, hail damage, floods, and uninsured motorist coverage protects you when the at-fault driver has no insurance. Given that roughly 1 in 8 drivers on American roads is uninsured, this one matters more than most people realize. The key insight: once your vehicle's market value drops below 10 times your annual collision premium, seriously consider dropping collision. An 8-year-old car worth $4,000 does not justify a $500 annual collision premium. And shopping your coverage every 2 to 3 years can save you $500 or more annually. Insurance loyalty rarely pays. Insurance is not glamorous, but understanding it is one of the most consequential financial decisions you will make in your lifetime. Term over whole life, health savings accounts, dropping unnecessary collision, shopping rates every 2 years. These 4 principles alone could save your family tens of thousands of dollars. If you want to keep building this kind of real financial intelligence, no hype, no sales pitch, just the knowledge the industry would rather you did not have, subscribe to Insure Smart right now. Every video is built to give you the clarity you deserve. We will see you in the next one.